Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinion. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities. We do have a question and answer session coming up on Sunday, 5 p.m. Mountain Time. This is where you can interact directly with me. You can ask me questions, and I will give you my opinions on those questions that you ask. And a lot of it deals with charting, technical analysis, and whatever else, and maybe even the fundamentals and presentations that we can go through for the companies. Starting with Samantha LeDuc. She says, the best definition I've seen on Bitcoin, even better than rogue money, is a non-inflationary liquidity decoy to prevent flows from going into commodities. I think we're getting warmer here, Samantha. I brought this up a while back about creating intangible assets to soak up liquidity, aka a non-inflationary liquidity decoy. I think she's on it, and I would say that's probably the closest definition that I would put on crypto in general. She says Bitcoin, but just crypto in general. Um, Coming on down, part two, early spring, I guess. So let's do this first. Natural gas is going to hit $10 late this summer, barring an incredibly unlikely ban on exports. Don't see any other way around it now that doesn't involve a time machine. And then part two to that. Early spring, I guess, but all it took was 1 month of decent winter weather to get back to this point again, where it's too late to stop. February blowtorch is our last hope, and he means a very hot February for us to kind of build back inventory. Again, this is the understanding of days of coverage of the inventory we have in natural gas. It is incredibly small compared to what it used to be 10 years ago. So we've got this small days of coverage, and all we need is demand to kind of swing back and forth from weather, which can dramatically increase or decrease the price of natural gas. So we are going to get bigger and bigger, more volatile swings out of natural gas over time. So the way that you play this, in my opinion, is you don't wait necessarily to see the price move and wait and break for, we'll say, breakouts in natural gas itself. You want to look at the equities. The equities are moving at warp speed compared to natural gas itself. So if you look at some of the natural gas equities, not all of them, but some of them, they're up over 100% in 2024 off their bottoms, well over 100%. So there's a huge opportunity to buy these things when the ratios are incredibly cheap. And that's exactly what what we have done on the website. Now, there are other opportunities that are cheap at this point besides natural gas. Because I know a lot of people will see natural gas, they say, oh, $10, and we're at $3.70 or something like that. And they'll say, well, that's a big move. It is a big move. But your risk reward in the equities was not anything like it was in 2024. Everyone is always trying to chase, is what it seems like. Try to be on the front edge. The front edge of it is where you buy really, really low. You may have to have a little bit of patience, and then you let it rip. You just let it rip. And then what you do is you've got 6, 7, 8 ideas in the portfolio. You add to some of these ideas, not all of them at once, but to some of the ideas where they're cheap and they're low. And there are spots that are cheap and low today that are very similar to natural gas when it was in 2024. And then when natural gas starts to move or some of these other areas start to move, you just let them go. You let them go and let them make you money. You ride them on up. You get a couple 100% or more. And maybe it's way more than that. I mean, if we go to $10 and depending how long on how high it stays there and long it stays there, we could see many multi-baggers on our natural gas stocks. So we just sit and wait. We sit on our butt and do nothing. And then we look for other opportunities and we buy those other opportunities when they are really, really cheap. And, there are things where they are cheap because of the strong dollar. And when that dollar drops, guys, we're going to see emerging markets. We're going to see a lot of these things rip. And I mean rip. Not there yet, but we're getting there. Great Marty says, pay attention, cattle to slaughter. And this is Bitcoin versus the US dollar and the potential breakdown. He's saying lower. Now, am I in that camp? I'm not in any camp, guys. I don't own Bitcoin. I've got nothing in this race here. I'm just watching it. I'm afraid that Bitcoin is just an extension of the NASDAQ. That's all it is. It's an extension of the NASDAQ where if the NASDAQ were to roll over, then I think Bitcoin could potentially roll over with it. We don't know that because we haven't gone through a cycle where the NASDAQ went down and Bitcoin went up. In terms of the NASDAQ being an overpriced sector and then going down for 10 years, is that going to impact Bitcoin for 10 years? I don't know yet. But this very well could be a possibility. Paul, another one, he likes talking about nat gas, and I'm seeing nat gas kind of break out, so I'm sharing some of the nat gas stuff. Storage volumes could be below the 5-year average for the first time since late 2022 as soon as tomorrow. Celsius is saying minus 251, but real time demand numbers are more indicative of something well over 300. Think of it as a deficit of 300. I'll elaborate on Saturday once the weather is fully actualized. And that's that small inventory. The small inventory and the big deficits from weather can eat through the inventory very quickly. And people just aren't used to that. They're used to what it was back in the day when we had much less electricity demand soaking up a bunch of stable demand. And then the weather is getting amplified on top of all this for the demand. Our inventories haven't really grown much. So we can eat through from full inventory to the bottom of inventory very quickly, depending on weather. So this is Peter Lynch. Peter Lynch here. He says Peter Lynch achieved a 29.5% annual return for 13 years. I spent 100 studying his strategy. I will explain his strategy in 10 simple steps. And just to let you guys know, when I purchased my my original positions in oil on the bottom of 2020, I had some other stuff too, some uranium and whatnot. My returns from 2020 to 2022 beat Peter Lynch's 29.5 annual return for 13 years. I beat him in 2 years, my entire portfolio. Now, was that part luck? Yes, it's part luck because I didn't know that it was going to do that. Was it skill? Yeah, it's part skill because I purchased the right area at the right time in the right companies. How did I do that? I did it with the 3 pillars and I did it with some tricks in identifying fractals. Now, can I do that repeatedly? That's the question. Can I beat Peter Lynch 3-year periods and then a 1 or 2 year consolidation, 3-year period, 1 or 2, that kind of Elliott wave move? It's possible. But again, that's not my goal. My goal is to make money and try to reduce risk as much as possible. The best risk reward entry points. And then I look forward using ratios and using basically the fundamentals of some of these sectors, I look forward. And what that does is it orients my ability to look at value only and then look at the fundamental setup that could change the valuation over time. I don't think any of these guys had anything like that. What they did, and we'll go over his strategy here, is they just bought companies that were undervalued and then held on to them irrespective of the market conditions. That's kind of what they do. I'm taking market conditions and then taking bets when the ratios are cheap and taking very leveraged plays with some of my money. And that's how I'm doing it. It says why you own it. If you don't understand the business, you are essentially speculating. Lynch had 3 criteria for simple, boring, and consistent. 2, earnings growth is the most important thing. And during our question and answer sessions, you guys know what I look like. I always look at the earnings growth. Earnings growth is what drives stock prices, earnings per share. And there's certain ways that a company can manipulate that. Like they can buy back a lot of shares, shrink their share count, and if their earnings stay the same, they're still increasing their earnings per share because they're shrinking their share count. So, as Jeff Bezos would say, the most important metric is free cash flow per share. And if you shrink your share count with your free cash flow, you can grow free cash flow per share faster over time than growing just free cash flow. It says this is as natural as stocks represent ownership interest in the company. If the company's earnings grow, stock price will necessarily follow sooner or later. Growing earnings is the most important thing. 3, fast growers in boring markets. Fast growers are companies growing at greater than 20% annually. Stalwart growing at 10 to 20% annually. And slow growers are companies growing less than 10% annually. So what I've done and what I look for is I look for fast growing companies at very low commodity prices. And then when the commodity grows, you can get a commodity that grows faster than 20% annually. And the company on top of it is growing faster than 20% annually. And what that does is you could get potential setups where the company is growing 100% plus annually for a period of time. It could be even more than that. There are companies that I've been in that have grown earnings over 1,000% or 2,000% over a few years. I'm just doing what he's using and doing it on a shrunk time frame. The problem is these things only work when the commodity price goes up to give you all that leverage. And we've been in a consolidation for a little while. So we've been consolidating sideways for 23 and 24. Some of the companies are still up 20% plus over those time frames because the commodity price was going sideways, but the company is still growing their earnings per share at a rate of over 20%. But the real fireworks start when the commodity takes off and you get that leverage on the fast growers, which is a high cost producer in a commodity that grows rapidly. Number 4, eliminate expensive stocks. Peter Lynch thought a fairly valued company would have a price to earnings PEG ratio of 1. So anything over a PEG ratio of 1 is overvalued. Anything under a PEG ratio of 1 is undervalued. Earnings growth is the most important thing, but overpaying for growth is a cardinal sin. Look for strong financial performance. He insisted for a strong balance sheet. He looked for debt to equity 1, debt to EBITDA less than 5. and then a return on equity, which is greater than 15%. So if I were to break this up, there's a threshold on how much debt they can have. There's a threshold on how much debt they can have versus earnings before interest, tax, blah, blah, blah. And then your return on equity, when they reinvest money back into the company, the return needs to be greater than 15%. Your long-term return is generally your return on equity, if you want to know. Number 6, don't think it can't go any lower. Stock price is nothing but a number. As long as the business does good, it can always go higher. If the business does bad, it can always go to zero. Don't attempt bottom fishing. Buy quality companies instead. Don't try timing the market. Nobody can time the market. If you miss just the 10 best days in the market by trying to time your entry, it's roughly 50% of all returns. Don't do it. And I think the way that you want to time the market, it's not about timing the market of thinking that a recession's coming or something like that. You want to time the market by buying something that's undervalued. Your undervaluation is your timing of the market, if that makes sense. Number 8, don't try to predict the economy. Nobody can predict interest rates, inflation, economic growth, etc. If you spent 13 minutes thinking about economics, you just wasted 10 minutes. Think about businesses, not the economy. Number 9, don't over-diversify. Diversification beyond 15 stocks doesn't provide you with an additional protection against systematic risk. Don't do it. As Warren Buffett says, diversification is an insurance against ignorance, in his opinion. And commodity companies are a little bit different because there's things outside of their control that can happen. They're a little bit different. Don't sell too early. So number 10, don't sell too early. You need to sell just because the stock went up too much. You don't need to sell if the stock goes up too much, so to speak. Selling a great company early is a big mistake. Remember, lowest it can go is always zero, but the upside is unlimited. Keep it as long as the business does well. And this was my biggest mistake, was selling too early personally. And that's that there. Coming down, investment wisdom, more Peter Lynch quote here. So whatever method you use to pick stocks, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. It isn't the head, but the stomach that determines the fate of the stock picker. His ability to hold on is what that is. Rajit says, someone booked an appointment with me to learn how to set up her crypto portfolio. I told her, talk about Bitcoin only. She said, I want a diversified portfolio. I said, every crypto will trend to zero against Bitcoin. She said, you don't understand my needs, and canceled the appointment. In 5 years, when her crypto has massively underperformed, she will look back on the conversation and wonder why she didn't stick with Bitcoin only. Well, here's my question. If this guy's so convinced that every crypto will trend to zero against Bitcoin, what makes Bitcoin different? Why is Bitcoin this exception? Because it was first? I think the way that I view it the same as him, except I think the entire group of crypto will trend to zero, including Bitcoin. That's my take. Brady, the inflation we are experiencing lately is grounded in debt and synced currency debasement, and not demand because of a healthy economy. This means the consequences will be different and much more severe this time around. Changing fiat paper currency for hard assets is the way to go. He's right. It's not driven by monetary bank lending. It's driven by debt and synced currency debasement, which is fiscal spending. It's worse. Grady says there's no need to wait for the ratio of gold versus the S&P 500 to break out. The Dow to gold ratio below already shows gold is now outperforming the stock market. Institutions watch this ratio, and they need to wake up from their outdated 60 stocks, 40 bonds thinking. They better do it quickly. And they need to stop comparing themselves to the average of the sector, since most have to be wrong at big turns. The Dow to Gold ratio below had a lower low in April of this year after the 2 mega backtests. This confirmed further chart breakdown was coming. And now the ratio is breaking down further as expected. This means gold is now set to outperform the stock market. A very important chart for the next global macro trend. And with that, for global capital flows. Huge sector rotation globally is in the making. And as often happens, some have copied this exact chart. By just exchanging Dow for another index, or by charting the inverse ratio on the same time frame. Go with the original, not the copycat. Also, do note how amazingly perfect that second blue backtest hits the blue apex of the 25-year blue triangle. That is price memory. Just beautifully stylish, really. And that historical blue apex backtest on this chart, together with many other charts, helped us catch the big precious metals minor low back in February, March of last year. And there's the breakdown of Dow Jones versus gold. We are on our way. Here's another one, and this is just a big picture chart of the gold miners versus gold. I use the same XAU to gold ratio, and it looks fantastic. He says ratio charts are about relative strength. They compare the performance of one stock relative to another, and they are a useful additional tool for figuring out direction. In a PM bull, miners lead the big picture. In his opinion, gold miners are bottoming very big picture versus gold. Means gold miners are about to outperform gold long term, pointing out that gold miners have underperformed gold very big picture historically. Does not really have any meaning. Then is then, now is now. Profiting from the precious metals miners is all about timing. And if you get the timing right, miners outperform the metals by a mile. That is true. And hopefully that is something that is coming. Coming back down. And I just wanted to read this. This is unbelievable. This is the worst sentence I've ever read in my life. He says this is about oil. The market appears significantly undersupplied relative to historical norms, with current inventory levels indicating potential price pressure to the upside as demand continues to outpace bearish market expectations. That's the worst sentence I've ever read. I'm sorry. Um, so what we have here is when he's talking about this here, this oil inventory that's down in the middle of nowhere. So the market appears significantly undersupplied relative to historical norms. Duh. That's how we got down here. That's a total duh. So what I would say is current market balances are running deficits that led to incredibly low inventory levels, which will likely lead to increase in pricing. That's how you should say it. You should not say the market appears. You don't need to say appears. You don't need to say significantly. You can take these words out. The market is undersupplied relative. No, you don't need relative to historical norms. The market is undersupplied, and we can tell that with current inventory levels. You don't need to say indicating, and you don't need to say potential price pressures to the upside as demand continues. I don't do very well when people talk like this because they have like 20 words in this sentence that are not needed. When you look at a chart, and if that is how you think of the world, you need to just look at it and say, we have low inventory levels. The only way that you can get low inventory levels is by running deficits. The deficits are implied. Price pressures should increase to increase production or decrease demand. That's how you write this under inventory level to get it back to historical norms. You need higher pricing to incentivize more supply and kill more demand. And then you find the equilibrium between those two. But when you start to read sentences like this, I just read it and I'm like, oh my God, this guy's brain it's fried. Fried, I'm sorry. You can another in another entire industry that is fried. Go read the law. The law is absolutely written by a bunch of very they're writing the law so people can misunderstand it. They can write it very simple. But there's so many words that are not needed in there. It drives me crazy. You should be able to get your point across in the least amount of words. The people who are really good at doing that have better and more effective communication. So that's my take on that. I had to end it on that. So, but that's what we're going to end it on, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.